Despite seeing all the bullishness in the market right now, things could get ugly, and they could get ugly fast. You're watching the Stock Market Brief Show. It's going to be a wild, bumpy ride, so buckle up. Let's get into it. Jerome Powell, he's watching very closely this inflation number that came in last month at 8.2%. Inflation is still running hot and quite sticky, and they're doing what they can to tame it. 82.2% probability that the Fed will raise their rate hike 75 basis points in the next meeting. They're also trying to reduce their balance sheet. As you can see, it's heading down, which is causing the stock market to be very volatile, including that David Hunter style melt-up rally that we saw over here, including the Apple's earnings coming in at 7.55% on Friday. But this rally, let's be honest, it really kicked off with our friend Nick Timiraos, Nicky Leaks. Fed set to raise by 75 basis points, debate size of future rate hikes, where basically the market was determining, in the way the price action moved in the market, was that the Fed was going to pivot. That right there shot off a huge 7.2% rally in the market. As you can see, it was released that day right there. Now, this weekend, he came out with another article, womp, 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 walking back some of that talk. You can see here the big question heading into the Fed meeting is about what, if anything, Powell will say about December. Interesting. So now all of a sudden the talk is changing. Listen to him here.
Think this current stock market rally influences their decision making, if at all, if it continues into the meeting next week?
Yeah, it's not just the stock market. I mean, they care about financial conditions, credit spreads, borrowing costs. And so if you were to get a sustained, a dramatic loosening of financial conditions, something like what we saw in July and the first half of August, that would be a conundrum for them. It is counterproductive for them. They are trying to achieve this process of disinflation. They need financial conditions to get tight and stay tight. And so that's really the challenge here, communications-wise, is how do you signal that a slowdown to 50 doesn't mean that you're about to stop? It doesn't mean that you've changed your view about the trade-off on inflation and growth. I think the bigger challenge, though, for the Fed is they need to see evidence that inflation's really going to come down, and that means unit labor cost growth. Labor costs have to decelerate here, and until you see evidence of that, it's hard to be confident that you can be change your position a little bit.
Now, people, inflation is still a huge deal, and the Fed is trying to reduce it. We got to look at the category weights here and notice how commodities is way up on that list, including housing, okay? And energy is also a big component. Now, what's interesting about energy, say oil, for example, being one of the commodities, it can have a dramatic impact across the board here. Now, if you remember way back when I showed Jesse Livermore's speculative chart, the accumulation cylinder, and the reason why I showed this was because it looked very similar to a certain commodity. Now, if you're new here and you have no idea what I'm talking about, well, make sure to like this show and subscribe to the channel if you want more technical analysis and intermarket analysis stuff. So, going to the chart of oil, what did it look like? Well, it looked like that accumulation, and we were trying to say, hey, was this right here the blow-off top? And so far, it has been the blow-off top. However, what I find interesting taking place in the midst of sticky inflation, boing, we have right now, I want to show you a descending, broadening wedge type pattern that if it breaks out, it can have a pretty solid price objective. Why am I talking about this now? Well, as you can see here, as we had this blow off top, oil right now is actually forming a very similar type pattern. You might even look at this and be like, hey, it could be a potential inverse head and shoulders. Now, I'm not going to go into the psychology of why that could be important, but if we do start breaking out of here, that could set up a target for right around this 105. So if oil goes to 105 from where it was way down here at 80, that is not good for inflation. As we already know, energy is a huge component. Commodities is a huge component. We got transportation, and oil can affect all of these. People, that is not a good thing. So if the Fed sees this and sees the market rising, that is not a good sign. Remember Jerome Powell, July, August, when we saw that big market rally, he came out and he was not happy about it. He came out at Jackson Hole and basically shot down the market with his own bare hands. Now, it's not just the oil chart. If you look at CRB Index, you can have a falling wedge type pattern where we have an expansionary type move to the upside, and now you see lower highs and lower lows, prices contracting. So if we get some sort of a breakout, do you think Jerome Powell is going to like seeing the CRB Index, which we know the Fed tracks, seeing this take off? No, because that is not good for inflation, which we've still been going in the 8%. So if inflation hit its peak right over here, but it still remains sticky over here, the Fed is going to continue to fight and we're not going to see the pivot, okay? Like, what's so crazy about the Fed's going to pivot, you don't understand. The Fed hasn't even paused yet. The Fed, first you got to go slow. You got to slow down the pace of the hikes. Then you got to pause. And then you can get a pivot, okay? Now, coming into next week, guess what we have? We have the Fed interest rate decision, along with some other important stuff going into the next week, including the non-farm payrolls. This is going to be a key component of next week that we need to pay very close attention to. So put this on the calendar, November 2nd. This is, I believe, PST time. So you just pull it up on Trading Economics calendar if you want to see what time it is for you. Okay, so that's going to be important. You don't want to have a huge position on and all of a sudden this drops when you have no idea and you get all side swashed around. Now let's take a look at copper. Very interestingly enough, we had a huge day in the S&P 500 on Friday. But take a look at our little friend Dr. Copper. It did not have that good of a day, and this could sometimes be a leading indicator. So if copper continues to get shot down, well, guess what typically follows? Typically the market, okay? And now the very same situation when we saw copper starting to rise over here, but the market at that time had this little red day, we called this out and saying, interesting, copper's taken off to the upside. Maybe something will tell us that the stock market can follow. Now this is on the back of a 10-year yield that has higher highs and higher lows. Yeah, we talked about this negative divergence, right? And the price momentum was kind of slowing down, but be mindful that this whole thing right here is just putting in higher highs and higher lows. It's trending up. So we're getting a pullback within an overall uptrend. So if this starts breaking out to the upside, that's not good for growth stocks. And we can see here, TLT came to its lower portion of the channel. I'll mark them right here, low, 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 and it bounced right over here. High, high, high over here. So it's in a perfect downtrend. And all we're doing is getting some relief type of move into the middle of the channel. And go figure, this date right here when we capitulated was when that article actually came out. Now, just on top of all of that, look at the curves, the 10 and 2 year curve and the 10 and 3 month. So this is telling us that the 3 month is trading at 4.18%. That is insane, all right? That is above the 10-year yield. Okay, so that means the curve is inverted and it remains inverted, and it's inverted right now at 16 basis points. And same with the 10 and 2. When the 10 and 2 crossed over, we started talking about the 10-year and 3-month, the Fed staple. When these both go into inversion, you typically get a recession within about a year. Okay, that's not me just saying a narrative. That's just what has happened in the past. Okay, so we're getting inverted. The longer we stay down here, the more likely that we are going to be getting that recession. So buckle up and do what you got to do to protect your household. All right, you don't need to worry about the overall economy. Make sure, before worrying about your current economic state, okay? And then you can worry about all this other stuff. The dollar is still in an uptrend. Now, I will say that it did kind of break down from this compression pattern over here, a little bit of a back test. So if this starts heading down, that could perpetuate the S&P 500 up further into a potential trend line, which we'll get into. But overall, be aware, right? The dollar is pulling back in an overall uptrend, higher highs and higher lows. Nothing new here, people. If the dollar starts shooting off like up to the upside again, what do you think is going to happen to the S&P 500? Okay, volatility also is coming off hard and fast as we're getting those articles, as Apple reported, boom. And this is despite seeing horrible earnings that week, where most are significantly down on the week. However, Apple, right, really held the market together. So volatility is getting suppressed, but don't forget what date it is, right? It's October. I pulled this October 28th. It's October 29th now. We have one more day left in the month. And when you typically get, right, vol suppression into month's end, where you get month end markup. So this is all part of that process. So we need to be very patient coming into the beginning of November, right? When as soon as we get that month end markup and then we have the Fed coming out, it can get downright wild. And that's not to say that the market can't continue to go up, but we just need to be aware that volatility still remains high, including in the NASDAQ, where the NASDAQ volatility is still above 30. Russell volatility is still above 30. Let's go ahead and point out the expected moves, okay? The expected moves. So go ahead and screenshot this page and you can put these on your charts if you would like to. These are the upper levels. These are the lower levels of what the options market is pricing in as far as forward-looking risk. It's important to know these right here is the ranges. So the S&P 500, we're looking at about a plus or minus $117 move, and you can see down the list. And then this is obviously the SPX, SPY, Qs, IWM, and I added in the Dow Jones Industrial Average because it's been on a monster tear. Now, if we look at the 15-minute time frame overall, right, this little tight little wedge pattern came into the 5-day moving average, started moving. Now after hours, right, when Apple reported and Amazon reported, it came down, and it came down actually to a key level that we were paying attention to, but that was in the after hours. And then it opened up right here, and we started to see a nice, huge, just monster squeeze, melt up type rally, rip your face off, to say the least, 2.38% up on the day. So overall, this is pretty positive, right? We have some key levels to watch. This is the market bottom, so that's important, right? Then we had a pullback here, that's a higher low, and then right here is a higher low too as well. Now we have another established higher low. So as long as we can keep these higher lows intact, that is going to be bullish for the overall market. Now, as soon as we start taking them out, be careful, okay? At that point, you got to still remain careful because we're seeing monster swings, but that so far is looking pretty decent overall. So if we get a pullback to the lower weekly expected move, which is right at about 377.50, that would bring us actually to this prior area where we've actually seen prior support in there too. So that's actually a bullish sign here, setting us up to potentially go test 400 in the SPY. But remember, Jerome Powell, if he sees this and doesn't like it like he didn't like it in August, yeah, he can smash this down in, with a few words. Take a look at the Qs. The Qs remain in the chop box. However, I will say it is somewhat positive, constructive base building, right? We have this left shoulder, head, right shoulder building up right here, which means that if we do start breaking above this 285, that can potentially shoot us to the upper weekly expected move at around 292.50, and that could be the start of this inverse head and shoulder breakout. If you take a look at IWM, so I don't have the weekly expected move from last week here, but you can see it was right here. The market got above it, it bounced on it once, came up, bounced on it twice, and then started breaking out. Okay, so it's pretty strong overall. For the IWM, it finished up 2.27%. We're looking at about 190 to the upper weekly expected move, to 176 to the lower, and that would just take us to where? It would take us to right here at these prior areas of resistance, and then it would maybe take us right below this 5-day moving average. So even if we do get a big hit here, it's not the time to get extremely bearish exactly at that point. You want to be constructive and wait to see how price forms in this area and see if it does something like that, where you can have a better stop loss and so forth from that point. Now, the big trends to watch are here. Dow Jones Industrial Average has been on a monster tear. Why? Well, it's because it's holding value stocks, and well, growth has been getting hit and value's been doing relatively well, including, one of its bigger components, UNH. Now we have resistance. Now we're above a declining 200 period moving average. So that right there in itself is not necessarily a buy signal because it's still declining. You want to be patient and let it be constructive, but we're coming into this trend resistance where we've gotten rejected, 1, 2, 3 times prior. So be aware of that. And the RSI on top of that is coming into that overextended territory. So what you want to see is this start digest the move, right? Flag, do something like that. What you don't want to see is boom, obviously another big, huge hit to the downside. So be aware of that. If you like to fade markets, I can, coming up here, it's basically a pullback within a downtrend. So I can understand why somebody might want to fade into that, or potentially play a U-turn where price gets above it. And then maybe you just wait for it to come back down and then you execute, into the downwards move back below that 200-day moving average. Could make for a good risk to reward trade right there. SPX, it is far from this, 4,000 level, but it's still below that declining 5-day moving average in this trend line. And you can see here these prior areas of resistance resistance. So if we get a continued move, bam, that can take us up into that area, which we can pay attention to. That's a very, very strong move. And I'll be honest, right, like I said over here, right, when we got this big rally, what happened over here? Well, Jerome Powell did not like that, right? And as you know, the interview with Dick Timiraos said, you kind of caught that too. It might not be the most constructive thing to see the market really take off like that. NASDAQ 100, it is forming this inverse head and shoulders like we already previously talked about. So a neckline break of 11,750 can take us to that declining 200-day moving average from a bullish perspective. Now, if we take a look at the NASDAQ summation index, we are still in a bullish trend. We talked about it day one when it flipped over, and we're starting to get that rally, okay? If we start seeing this obviously turn back around, you know, be aware of it, but, you know, we'd want to see the parabolic star uptick over once again, and if it does that, that could start that bearish trend back down to the downside like it did really right over here where the market started obviously moving down. Okay, now on top of all of that, we got to look at these BP charts for technology. Technology is getting burnt to a crisp, but remember, it was getting burnt to a crisp down here on a positive divergence, and guess what? It was so overextended, it shot up and went extensively higher back up to where it's been in prior areas and prior turning points, okay? So yeah, now it's back to overextended. So technology could be potential opportunity to short things like XLK. Keep an eye on it. Remember, Apple is a huge component of the S&P 500. It's like 7% of it. It's incredible. Financials also getting very, very frothy right over here, right? Strong move. This rally's been straight up, as you can see over here. And then energy obviously has been moving, grooving, you know, cracking just about to another high over here. You can see if that was a high. I don't have the exact chart up, but also you can see here the chart is getting overextended. Now the buy signal was activated. We had to move up higher. Sometimes we can get like a, you know, 4-day rally. Sometimes it marks even bigger rallies. It doesn't tell you how high it's going to go, but hey, you never know. It might cross back down and we might get another buy signal where it continues to move to the upside and bring us back into that 4,000, maybe 4,200, back into that trend line area that we just recently discussed. So that's positive. Also to note, Bitcoin and gold, we had that buy signal. It crossed over this weekend as Bitcoin started to take off to the upside. So we're on an activated buy signal right now. So we got to watch to see if this starts turning back around down through that zero line. If you don't know what this is, the Saylor to Schiff tool, I'd recommend go watch that video. Link is in the description. And one last thing that I want to call out too is the McClellan Oscillator. This right here is pretty interesting, right? We've been seeing a big move to the downside, and now we're getting a little bit of breadth to the upside. And I wanted to call out these big breadth moves to the downside. I want, you know, right over here, have lined up with these type of bottoms. So you can see the bottom here, and then potential bottom over here. And now what caused this to actually be the bottom and start moving up higher was something very interesting. It went from these overextended areas to overextended to the downside to overextended to the upside. And what we're seeing right now is actually a very similar type move where we got this big breadth thrust from a very negative area. So if that's the case, maybe the New York Stock Exchange is getting ready, which, you know, is a broad market, which is a lot of, you know, smaller stocks too, and we've been seeing strength in the IWM. Perhaps this is telling us, hey, we could be carving out some sort of bottom, maybe for the year, you know, get a Santa Claus rally, maybe, you know, it's seasonality, we can get these rallies. It's always a possibility, people, so we got to at least be open to that. Like I said, the market still remains very volatile, and it can move 2% in a day. It's trading like a darn penny stock, so this is not a time to really just go hack nasty with your portfolio and be absolutely crazy. Be tactical. You don't want to buy these highs and then all of a sudden it pull back on you and then you freak out and get out and then it starts ripping back up. Position size correctly. Focus on risk. Right now the short-term trend is on our side. We are still on a longer-term downtrend. So be careful out there. Hope today's episode helped out. See y'all later.